Hey, welcome back to the Explore podcast with Scott and Ryan.
What's going on?
We like to talk real estate, entrepreneurship, motivation, and a whole lot more. Scott, what's up?
Not much, man. I've been a pretty cold day here in Kansas City. Been a beautiful week. And then all of a sudden today went from about 60 to 25 outside and windy and freezing cold.
Yeah, it's great
It's
here in Southern California.
Yeah, must be over there.
Yeah. And you heard the third voice.
Yeah, there we go. Hey guys, John Kelley, good friend, a partner of ours here in the Kansas City market. He is on the podcast today. He is one-upping me with the same pullover on. Looking real fly over there, Johnny boy. But John, we'll let you kind of introduce yourself. Tell us, who you are, what you do, and then we'll kind of just get into things.
Yeah, thanks for having me on, guys. I'm really stoked for this opportunity. My name's John Kelley. Like they said, I work for Harvest Bank here in Kansas City. I do all loans. Any type of loan. I firmly believe that everybody deserves a loan, no matter how big or small, or what hurdles we got to cross to get them in there. But I've found a niche, most specifically in physician loans. Over the last decade, working with medical doctors, to help cater custom financial solutions to their lives. And I try to do that for everybody. I run my business in a very unique way, in a sense that there's no one size fits all to lending. Everybody's situation's different. Everybody comes from different walks of life and have different hurdles that they need to cross financially. So what I really try to do is put myself in those customers' shoes and really try to cater solutions that are specific to their financial needs, and not just what's good for and what's easy necessarily, but what's going to put them in the best situation to succeed financially with that home purchase.
Yeah, John, he's a little nervous, guys. If you couldn't tell by how fast this guy is talking and trying to get this whole spiel over with in 1 minute. It's like, hang on a second here, Johnny. We're going to pull you back.
Hey, that's the elevator.
He was just telling us. Yeah, that's right. No, it was great. Great intro. And real quick, John was telling us right before we hit record here, his heart rate's at 120. So he is a little shook. I think this is the first podcast this guy's been on or something. I don't know why, because he is not a shy person that I've ever seen. John, are you shy normally?
I've never been accused of that in my life. I've never been
I was gonna say
shy. Pretty outgoing person. Borderline weirdo, probably, because I just try to make friends out of everybody.
Just a little bit, and he talks real fast, and he never stops talking. So it's like one of those things.
That's why Scott and I get along so well.
That's right. That is very accurate. No, John's a heck of a golfer too, Ryan. He acts like he's not very good, but this man can play some golf.
Yeah, my game's getting bad though. I need to play more. I don't practice.
Well, it's because you have all those kids. You haven't stopped having kids for 3 years.
I know. Will you come over and tell my wife that? Trying to get my golf game up. She just keeps wanting to have more and more babies.
How many do you have now?
We've got 2 right now, but I think that she's got a grand plan to maybe add one to the bunch.
Oh man, well, hey, good for you. I know Ryan over there.
To anything going on necessarily, but happy wife, happy life, right?
I don't know. Sometimes, not always, man.
What do they say? It's cheaper to keep her or something, isn't that what they say?
That's the way. That's what I like to hear.
Yeah.
No, that is so true. And Ryan, he's got 3 kids himself there in California, and I can't imagine. We were doing another show the other day, and some of the kids walked in on us as we were doing it. So it's always fun to have guests on the show that were unexpected.
Yep. We're shooting for 2, and then we ended up with 3, and so we had twins on the second round. So we went 1 to 3. But
I keep telling my wife that's going to be our luck. We're going to go from 2 to 4.
Probably so, man. Probably so. Well, let's get into it.
That out there.
Oh no!
What's that?
You keep joking about it, and it's going to happen.
I know.
Now let's get into it. So let's talk a little bit. So obviously a lender. You gave again, your elevator pitch was great, man. You hit a lot of topics, but today we really want to hammer down. And guys, again, John does do all types of loans, but Arvis Bank, they in my opinion, they offer one of the best physician loans, if not the best here in the Midwest, at least, of anybody. So, John, give us a little more details. What states, first off, do you guys lend these physician loans in, so we can clarify that first? And then let's get into what these physician loans look like, what the requirements are, and how they're better and unique compared to your traditional, conventional Fannie, Freddie, FHA type loans.
Of course. So
start with states.
Yeah, we operate our portfolio lending within our banking footprint, which is encompassed in a 4-state region between Kansas, Missouri, Arkansas, and Oklahoma. So we do physician loans in those states exclusively. Now, there are some loopholes to that because it's obviously our product. We write the book of guidelines. We don't answer to any third parties or any entity above us that tells us what we can or can't do. So I've actually done a few outside of the footprint in special scenarios where they've got an established relationship with us that precludes them moving out of our footprint. Typically, it's going to start with them being in that footprint, establishing that relationship, a relationship deeper than just the mortgage. Getting banking services, other products like that, maybe investment accounts. And then once they're established in our system, our bank really tries to fully serve those customers, even if that means they're moving out of our brick and mortar footprint. Because let's be honest, this day and age, you can bank from just about anywhere. I mean, how many people actually physically walk into a bank branch these days? I know that I do because I work at one sometimes, but if I'm not walking into the bank to go to work, I can do mobile check deposit on my phone, all that type of thing. So moving into the digital age, we find a lot of customers that really love our service and love what we offer from a banking standpoint, that even though they're moving to Wisconsin or they're moving to Chicago or they're moving to New Jersey, they want to keep that relationship that they've established with us because they value it. And if they do, we can, in some certain instances, step outside of that footprint. But, for the sake of this podcast and kind of what we're talking about today, 4 states: Arkansas, Oklahoma, Missouri, and Kansas.
And I want to throw out there real quick, guys. Did you hear how slick John tried to say that a little bit ago? He said they have relationships deeper than just the mortgage. What's John doing? He's trying to get them to use him as a banker too. What a sales guy. That was slick.
Yeah, that was for the bank. You're welcome, Arvis. Go ahead and put that in.
Yeah, no kidding. That was about the most smooth way of saying, "Hey, use this as your banker too," that I've ever heard somebody say it. But I liked it, man. That was great. So you have the 4-state region. Let's get a little bit of background here real quick, though. Arvis Bank, tell me if I'm wrong. Arvis Bank is a Walton family project or bank, I guess, technically, right?
We're not. Or we're owned by the same company that owns Walmart. We're owned by Walton Family Enterprises. So we're privately held. Okay. We are the largest privately held banking institution in North America. We're about a $22 billion bank from an asset standpoint, and we are owned by one family. We don't have any investors, stockholders, anything like that. Obviously we have a board of directors, but we don't have like a stockholder meeting where we've got to keep everybody's profitabilities and their payouts high, which makes us more liquid from a standpoint of, the story is when Jim Walton made the decision to bring Arvis to Kansas City, they told him, they said, they ran the budget and they said, here's our expectation. We're going to lose $10 million the first year. And Jim Walton said, well, dang, if you'd have told me we're only going to lose $10 million the first year, I would have went to Kansas City a decade ago. Which is crazy to us. We're like, 10 million, my goodness. But, you have to spend money to make money, right? And I think he saw the opportunity that Kansas City provides. And, that was our first step into Missouri. Technically, we had some branches in Pittsburgh. I take that back. We've got a small bank group out of Joplin and a little bit of a presence in Springfield that's kind of branched up from Arkansas. But really, the stronghold of our Missouri business came when they decided, to purchase a group of banks. They bought three different, local banks and merged them into the Arvis platform. I believe it was back in 2010.
Yeah, it hasn't been too long, but it makes complete sense. And if you don't know, the Walton family, their huge industry is down in Arkansas. So that's why I was trying to figure out, why the Midwest. But it's because they really like to keep deep roots here in Arkansas. They've really done a lot for, and then all these Midwest things. So yeah, okay, perfect. On to the next part of this. Why is Arvis able to, and you've kind of hit on it, but they're able to offer these because they're privately held, correct?
Correct.
These great physician loans. So your product is unique in the aspect that you don't have the same guidelines or requirements that Fannie or Freddie loans have or conventional loans have, correct?
Well, a lot of them actually, Scott, are going to follow conventional guidelines because when you think about mortgage, and you think about a mortgage product, there's just so many, all regs is like a book like this thick, and that's conventional lending regulation, right? So when a bank, takes and rolls out a product, what they're looking to do is they're looking to make some small tweaks to what the baseline rule book is. So really, in a lot of instances, our physician loan follows that of a conventional loan. There's no prepayment penalty. You could pay as much extra as you want. There's no balloon note. It's really follows that conventional structure, which what we know of as a conventional structure is the loosest policy as compared to like government lending. Government lending can be much stricter from a lending policy standpoint. Conventional is seen as like Scott, when you get an offer on a house, you're comparing two offers side by side. One's conventional, one's FHA. The belief, and it's true in 99% of situations, is that conventional loan is going to provide less hurdles to get approved for that client than an FHA loan might. So it follows conventional guideline, but there's some massive endorsement changes that really make it a physician loan. One of them is there's no money down required up to 1.25 million, and there's no private mortgage insurance on the loan. That's the big piece of what makes a physician loan a physician loan is that a doctor or client can buy a home, put no money down under that 100% cap, which ours is 1.25 million, and there's no private mortgage insurance on that loan. Now that's one of your biggest banner endorsements or banner differences between what a conventional loan would be versus a physician's loan.
Yeah, so hold on there. So you said no money down, up to 100% financing, correct?
Mm-hmm.
But actually, it's up to 103 on your guys' loans, correct?
It is technically.
You guys go just a little bit over.
We'll let them finance their closing costs. That 3% allows the customer to finance up to 3% of the purchase amount worth of closing costs. If you're a resident and you're buying 250, you probably still shouldn't have any issues with that 3%, in closing costs. Obviously, if you're buying $1 million house, you're not going to have $30,000 in closing costs in most scenarios. So that 3% is designed only for the use of cost to close. Like you can't finance differences like in an appraisal or something like that, but you can definitely pay your closing costs. So, let's use an example. You buy $1 million house, you're coming out of training, you've got expenses, you're moving your family from across the country to, across the country, and you want to buy a house, hold on to your cash. You can, buy $1 million house, finance all your closing costs as a part of it, get into that house without coming out of pocket with any money, and have no PMI on that loan. And typically an interest rate that's significantly better than that of a conventional loan. It really is a great deal. When I see physicians that use non-physician loans, I kind of think to myself, like, well, what are you thinking? You've got access to this loan because of the time you've spent training for your profession, getting a medical degree. You've got access to this. Same kind of thing for you, Ryan, being in the military. You've earned the right to use that VA loan by your service to our country. You've earned the right. And in 90% of scenarios, it's going to be the best option for you.
Right.
Same thing with the physician's loan. When you get your medical degree, and you're a medical, I don't want to say medical professional, but you're a doctor, you're a physician. You've earned the right.
A dentist.
Yeah, dentist, optometrist.
We've done dentists together.
Mm-hmm. Yeah, optometrist.
Yeah, let's run down that actually. And I don't mean to interrupt you there, but I want to make sure we hit this point. Will you kind of run down the list of the specialties that do qualify? Because it is a little bit unique. I say medical professionals, right? But you make a good point. We don't want to say medical professionals because it doesn't relate to all of them. So will you give us a list of kind of all the different fields, and maybe not all of them, but a majority of them?
Your two main physician types are MDs and DOs. Obviously, MD, medical doctorate. DO, I believe, is a doctorate in osteopathy.
So I don't know. Yeah, osteopath.
Yeah, I'm just a dumb lender. I don't know how to pronounce those big words.
You're lucky. Yeah.
MD, DO, right? And then you've got the OD, which I believe is your optometrist, and you got DDS. And I believe there's another endorsement of like a DDS is Doctor of Dental Surgery, but I believe there's another dental type medical degree.
There is.
Let me pull. I've got the list right here, and I can pull it up really quick. But
it's a pretty good niche, though. We don't see many of them.
No, really don't. We really don't. But mostly, you're going to be your MDs, your DOs, your ODs. Ophthalmologist. I believe an ophthalmologist is technically an MD that does a optometrist residency. It's considered an ophthalmologist. And I've got this right here, and I'll pull this up while I got you on.
Does not do chiropractors.
We
does not do veterinarians either.
Yeah, and obviously
pharmacy. No, you don't do any type of pharmacy.
No, we do not. So here it is right here. Doctorate of Medicine, DO, like we said, Doctorate of Dental Surgery, Doctorate of Optometry, which is an OD. So it's those four specialties: MD, DO, DDS, and OD.
Okay. Awesome. Yeah, there's always question there, and people try to push the borders, and it's like, hey, these are pretty specific guidelines that they have. We can't just get them to accept it because you might think it should be accepted, right? Like, we would love.
And there's definitely some that I think should be, but we actually, Scott, when I started with Arvis 8 years ago now, we actually did include chiropractors and veterinarians on that list. But what we figured out is that if you offer a product to a specific specialty, you've got to write a certain amount of loans to that specialty, or it ends up becoming a discriminatory lending kind of compliance issue. Like, you offer it to people. But see, the problem with veterinarians and chiropractors, what we ran into a lot is most chiropractors, you come out of school and you got to buy a practice. Very rarely, do you come out of school like another doctor would, where your salary is immediately, six figures. You might be starting off somewhere at a lower income amount, and then those student loans can weigh a lot heavier on your ability to buy. And we just weren't. And I remember they told me, this was in 2017. They told me, they said, we're going to be discontinuing this. And I was like focused on a group of chiropractors, and I was like, I just went like 2 weeks before that and spoke at the Cleveland Chiropractic College. And I was like, what? I was like, no, we can't get rid of chiropractors. I've got some, bait on the line here.
Pipeline.
Yeah. I'm like, what are we doing? But they looked back, and we had done like 1% of our physician loans, or maybe even like 0.5% of our physician loans had been done for veterinarians or chiropractors. And we just weren't fulfilling that bucket to be able to, justify continuing to offer it. And you know how it is in this day and age. Compliance can get you quick. And last thing want is catching heat from the Fed for one reason or another. And so they made the decision back then to pull them off the list. But it's always on the table that it could get added back. I was in a managers meeting a few weeks back, and they were talking about, they'd had a lot of markets talking about, what does it look like to add these folks back to the product, or to roll out a similar product for medical professionals, like your anesthesiology assistants or your PAs or people like that aren't an MD or a DO or DDS or an OD, but they're still very highly paid, like a CRNA, which does the job of an anesthesiologist, has a lot of training, have very high earning potential, but just not an MD or a DO.
Yeah, no, that makes sense. And hey, sometimes you just can't get past it. You just got to stick with what you got, right? So
hey, if it was my decision, everybody's included. That's why they don't let me make the calls. Yeah, that's why that decision's made above my desk.
Oh yeah, thank God. So let's talk a little bit more about the guidelines here. So one of the unique things, and I'm pretty sure this is right. You guys will take the higher of the two FICO scores between if you're a married couple, even if one, say the husband is not a physician. So like in my relationship, my fiance is a physician. I am not. But you can take my FICO score and use this loan still if we wanted to, correct? Because she is a physician.
Yes, we can actually. And Scott, it's not, you don't
That's a
even
big deal.
You don't even have to be married. I've had clients before that, their credit score maybe wasn't where it needed to be, and they had a parent co-sign with them that was not a doctor but had a qualifying credit score. So we use that program. The guideline is, every conventional FHA, VA, USDA loan, every government type regulated loan out there, we pull a credit score for each borrower from all three bureaus. You throw out the high, you
Hold
throw
on.
out the low.
John, so I can go get all these different girlfriends and I can just sign on every single house with every single one of them and I can get these doctor loans.
Yeah, but you're going to start to run into some issues because you're going to have a lot of loans. You're going to have a lot of loans on your credit. But in theory, yes, you could. Actually, no, I take that back because you'd have more than two physician loans reporting to your credit. And
there we go.
We'll get into that later. But my knee-jerk reaction is say, heck yeah, you could. Let's do it, But no, so we'll use the higher of the two credit scores. Every other loan program out there is going to use the lower of the two mid scores. But I'll give you an example. I had a client a couple of years ago that had a pretty rough credit score. He was a physician, but his credit score, he got into some trouble, towards the end of training, started his family, money gotten tight. We all know that these doctors are overworked and underpaid until they really cross that threshold into attending. And he'd kind of gotten into a little bit of financial trouble through that time. But his wife didn't work, but she had a credit score that qualified. So we were able to use her credit score, his income, and get the deal done. And it didn't take an exception.
That's crazy.
Yeah. It's a great,
it's awesome though.
More I talk about.
I work with a lot of these physicians and and that's how John and I kind of built this relationship. And especially residents. And to be honest, you were right. They are underpaid, overworked. I mean, and just getting by a lot of the time, especially during residency. But the reality is like, they're not in residency till their late 20s, early 30s a lot of the time. And by that time, they want to own. They don't want to necessarily live in apartments or, townhomes or whatever else. They want to be able to settle because when you go into residency, depending on the program, you could be there from 3 years to 7 years or more, because then you got fellowship after. So it makes sense, especially a lot of like the surgical residencies. You're talking 5 years most of the time or more just in residency that you're going to be in one spot. So do they really want to go rent for that long? Sometimes, yeah. It just depends. In today's market, a lot more of them are going to have to rent just because the market's gone so crazy. But previously, I told every resident that I talked to coming into Kansas City, hey, you're here for 5 years. I very highly recommend you buy a house. Like, not because I'm a sales guy, because it's a great investment. And the reality is all of them have done very well over the last several years.
Oh, yeah.
Now, again, I've changed that pitch going into this year and saying, I don't know. Like, the rates are a lot higher. I do still think real estate is a great investment. Obviously, invest in it every day. But the reality is 5 years is going to be on the border at this point. Rates are high. And the prices have just run so hard that it's like, I would assume so, but I can't be as confident as I was even 12 months ago and telling them, hey, let's buy some. Let's get you in a house. Now it's like, hey, you might want to rent, feel it out first and see what happens to the market. And you still have 4 years or more left going into next year. So we can look then. And we own a lot of rentals that we rent to these residents, and we allow the flexibility of, hey, if you ever want to buy a house, we're not going to charge you to get out of a rent, out of your lease early or anything like that, because then we'll just go to John and say, hey, John, get them signed up on the loan. Let's get them looking and let's find them a house. We're open to doing that and work with them because we want people to build wealth, own real estate, do this stuff. but sometimes it doesn't make sense. So anyway, off of that tangent, back to you and your loans. What other qualifications are we looking at, John? You said no PMI, so that's going to save them $100 to $200 a month on average. Obviously, there's a lot of details that go into that. Is that about right?
Yeah. It just depends on loan size, obviously. PMI is always a percentage of the amount borrowed, and it's a function of how much you put down. But, on the physician loans across the board, like I mentioned, we do 103% up to 1.25 million. So if you buy at 125, you can't roll in closing costs, but you can finance the full 125. Above 1.25, we're capped at 95% loan to value. So you could buy a $1.5 million.
Still really good.
Yeah, very good. In comparison, if you were doing a jumbo in today's landscape, a non-physician loan, because anything over 726,200, a loan amount over 726,200 is going to be a jumbo. And if you're in that jumbo realm and you're not a physician, in most instances, you're looking at minimum 15% down. Most places in this environment are going to be requiring 20% down because, we're going into a very potential market, a lot of volatility that, it could not be as bad, but of course everybody always looks at risk, like how bad could it be, and they expect the worst. So
and jumbo rates are usually higher as well. You're usually going to pay at least a point over prime, if not more, on a jumbo.
Significantly, yes.
So you're going to have to explain that to you guys. If you're not doing the physician's loan like we're talking, you've got to have your traditional conventional loan pretty much, or Fannie. I guess Fannie Freddie can do a loan up to, but then you're on top of that, you're going to have a second loan called a jumbo loan. So you have two loans versus the one loan, and that second loan is going to have a higher interest rate typically, really almost always, I think, than that first one will. So
your jumbos are still just one loan. They're still just one loan, but what it is what they do is, we have done a few, Scott, where they do a first loan at 726,200, and then we do a second mortgage to bridge into that. Yes, we have done that a few times. But to your point, when you do a jumbo, like let's say you're a doctor and you've got money, you're not coming out of training, you want to buy $1 million house, right? Well, you could do a 726,200 first, and then do a second, like Scott had kind of mentioned, but your second rate's going to be in the 8s to 10 range now. So a lot of less people are opting to do that, and most people are going for their traditional jumbo mortgage. And that jumbo mortgage means that you're going to have to put down minimum 15%, but most places it's going to be a minimum of 20. Some places over jumbo require 25% down. So if you're a doctor, you're looking at a physician loan versus a jumbo, run-of-the-mill jumbo product. The physician loan is going to have no MI and require, if you're at $1 million, no money down. If you're at 1.5, you only have to put $75,000 down, 5%. Whereas if you're buying on the traditional mortgage, you're putting $225,000 down, and you're still going to have MI on that loan because you don't have 20% down. What that feeds back into is it allows a physician to, Scott, why do you put 20% down? So you don't pay PMI, right? Same reason I do.
So
When I buy a house, I put 20% down to avoid PMI because that's considered one of those costs that you don't really get to deduct or anything. It's kind of what we call a sunken cost. So if you're a physician, you don't have to pay that PMI. You don't have to put any money down to avoid it. So in a lot of markets, you can keep your money in your pocket in an investment that's going to potentially earn you 6 to 10, 12%. Instead of having it sitting in your home, saving you 5.5 to 6, And
just to clarify, with the one thing on that MI, because this is one thing that drives me a little crazy with a lot of people, because I get asked this question all the time, or they'll tell me I have to put 20% down to not pay PMI, and I've had this discussion many times. You don't necessarily have to put 20% down. You can buy PMI out without 20% down. Just to clarify that, but John is exactly right. The 20%, obviously, but I always tell buyers, hey, in this environment, it doesn't make near as much sense to buy out PMI, but in previous environments, buying out PMI is an option that a lot of people should be looking at versus putting all 20% down, because you're going to put way less money down and still not have to pay that fee. But it's all an equation, right? how long am I thinking I'm going to stay in this house? And then let's work backwards from there. So if it's going to cost me X, I plan on staying in the house this long, 5 years, it costs X. Does that math make sense?
Yeah.
Or should I just pay the PMI on a monthly basis because it's $100 a month and I only plan on being here for 3 years? It would make more sense just to do that. Sure, there's all types of things that go into it, but yes, the traditional understanding is 20% down, don't pay PMI. You can put it into whatever else you wanted to. It doesn't even matter on these position loans. You don't even have that question because there's no PMI. You don't have to pay for it. You don't have to think about it. It's just not there.
Yeah,
it's a big deal.
I had a quick question for you, John. Is this the physician loans? Are they, because like Scott mentioned, a lot of they're only in that city for 5 years. Can they use this loan multiple times, or is it, like the VA? A lot of people think you can only use your VA loan once, but you can actually, there's ways to do it multiple times.
Of course, that's a great question. The answer is no. You cannot only use it once. You can use it multiple times. What we used to do is, it used to be at Arvest, you could only have one physician loan, one Arvest physician loan at a time. So that meant that if you were a doctor, you bought a house in 2015, you wanted to move out of that house and buy something else, utilize the physician loan again. We had to get a little bit more creative on the financing on the back end of that departure residence to free up that physician's loan. Or I'd have to partner with my guy Scott and say, hey, we need to make this a contingent sale so that they sell and buy simultaneously. And then if they did it that way, technically they don't have two at one time. One pays off the day the other one comes into effect. So we could get around that. Well, 2020 and 2021 threw us for quite the loop. And contingencies were no longer allowed. And I say they weren't allowed, but if you were contingent, you probably weren't going to get the house. It was that simple.
No shot. I mean, very rare would it work.
Very, very rare. You better have a really strong offer and maybe even know the person you're buying it from. But what we had to do is we had to look at our guidelines, because we caught, a lot of our customers, we felt like were being held back, or their offers were being discriminated against because of that guideline that we have. And this is one of the things that I love about the bank that I work for, is that we really truly are servants to our customers. And when we saw our customers, not getting homes that they were well qualified for, and in every other reason, we changed it. We said, you know what? Here's what we'll do. We'll let you get a second Arvest physician loan, but you're going to state that your intention is to sell the one you're departing after you move into the new one. Which, that's one of those things where it was a lot of risk on the bank side, because there's no way for us to go back and hold those people accountable after closing to make sure, what I mean? We can't make them sell their home.
And if the market dropped or all those other things too, there's a lot of scenarios that went into that. I remember when all this was going through, you called me one day to tell me all about it, because it was a big deal for us, because we were going through the contingent piece with a lot of people, and it was it was not fun, and it was very frustrating. And then you were like, hey, we just passed it.
We were having to get people to do bridge loans that really didn't need to do a bridge loan. Like, they
costed them extra money too.
The only reason that they could not buy non-contingent was that Arvest one physician loan policy. So I went to the bank and said, you know what? We could just send them somewhere else. They could get a physician loan somewhere else.
I remember this. John was fired up.
I was fired up.
Kidding,
I was
Ryan. John
upset was about it. I was upset about it because I thought and I thought that we were taking very good, valuable customers that have been loyal to us for a really long time, and basically telling them, like, here it is, eat it. Here's the sandwich, take a bite. And it's not a good look.
Yeah, if you want to get the higher ups' attention, if you're saying, hey, let's send the business we should be in and send them elsewhere because that's what they need to do. I mean, that's gonna stir the pot, right?
Yes, it does. That's one quick way to get the tree shaken, to say the least. And what I found was, hey, I don't even have to send them. All they've got to do is call any one of our competitors and their current physician loans with us. That other competitor doesn't care at that point in time that they have a loan with us. And basically it was eye-opening to the bank. And again, I credit the bank, because there's a lot of institutions that you can work where they're like, hey, this is the rule, take it or leave it. And Arvis, really looked at this from a logical standpoint and said, what are we doing here? This person's debt to income ratio is 20%. We go to 50. Like they could buy this house 2.5 times. Why are we letting this process be held up by one small factor, one small endorsement, so to say, to the loan policy?
Yeah, you brought up a good point there. So what John just said, debt to income, and we're going to talk about that in a second. But what happens is most of the time when they're going to buy the second house, it's that step up, right? So they're going from residency and they're going into that, hey, now we're attending most of the time, sometimes not, or, they might go to fellowship. But that's why he said, hey, they went from a 20%, we go to 50% at DTI. So that first house they bought was probably close to that 50%, but now they got a huge pay raise. They're making 4, 5, 6 times what they've been making forever. So now their DTI is so small in comparison to a lot of, their income, whatever else. Why wouldn't they adjust this to help their physicians that they've already got relationships with, that they know are now actually making the money that they're hoping on from the first day that they give them this first mortgage, where they take on all this extra debt and risk? Because when you're giving residents the original loan, that's a much higher risk than when they're an attending, because now they're actually making the money that you were hoping they would make back here. Right. But you knew that they weren't. It was going to be several years. Exactly. But now you're not giving them this opportunity. So you're losing this bigger note because you guys can't adjust and get them to where we need to be so that they can buy this next house and be competitive. That's a huge win for not only the clients, but for the bank. I mean, the bank was putting all their trust in these clients from day one as a resident, where they really don't make any money and they have all this student loan debt, everything else, hoping that they're going to become an attending and make this money. So
that's right.
Fixing that gap in between, it only makes logical sense. You said it earlier. That is so true. But talk about DTI, John. What is that? So like on these physician loans, explain how the DTI works. Do student loans get included? Do they not? But don't go too into depth because most people don't understand it. Just give us kind of the skim over the top of it.
Yeah, 10,000 feet looking down. So debt to income ratio is just what it sounds like. It's your debts as compared to your income, gross income. So not after you pay your taxes, but your gross income, and it's percentaged out. So, when you think about other loan products, conventional used to be capped at 45% debt to income. Now it can go to 50 with qualifying credit score. FHA actually goes to 60% if you're a strong enough, profile. But our physician's loan, and we're very unique in this because I believe we're the only institution that I've ever heard of, and I am quite the student of my competition. We're the only institution that allows you to go up to 50% on your DTI, and that's your back-end DTI. So that's all of your monthly debts that you pay, car payment, credit card payment, anything that you're paying on a monthly basis that reports to your credit, plus the house mortgage, full principal, interest, taxes, and insurance, all of that equated out to, against your monthly gross income. And that's a percentage. We go to 50% on that. And like I said, most of our competitors, are capped at 43. Some go to 45. But we go all the way to 50 on it. It's been that way since I started here 8 years ago. It's always been 50%. That's always been one of those guidelines that really kind of sets us apart. We're kind of known in the market, as Scott knows, we're known in the market. Other places get a deal that, they get it into underwriting. Everything doesn't quite shake out the way it's supposed to. They get a little high on that DTI. These other lenders know that if you want to save the deal, you just need to call Arvis because they go to 50. Most places.
Yeah. So put that into layman's terms. Run us a scenario. If I make $10,000 a month gross income, break it down.
If you make $10,000 a month in gross income, all of your monthly debts that you pay that report to your credit. Now, this isn't your car insurance. This isn't your power bill. This isn't your water bill. But the payments that you make that report to your credit month in and month out, all of them plus the new loan that you're taking on, the new proposed loan, can total up to a total of $5,000 a month. That's 50% of that gross monthly income.
And they're saying that the other 50% is to pay all those other bills that they're not including in that pretty much. They're saying, hey, the other 50% is what you live on. is how they
Pay your
break that down.
taxes.
So yeah, Ryan, does that help explain it kind of in layman's terms, somebody that's not in this field?
No, I think that's really going to actually put a timestamp and put clip, because I'm going to clip that.
Okay.
That's good.
Yeah, that was perfect. And a lot of people won't ever understand what we just said until we broke it down in that math equation. I don't think so. That
I think I take that for granted sometimes. You know, I've been doing this long enough that these. I remember I was driving to Colorado right when I signed my intent to come work at Arvis and to take this job. It was like 2013 or 2014 or something. I was driving to Colorado with my wife. We were just going to go on a little vacation, clear our heads before I started work again. And I printed off this big pamphlet of like acronyms, mortgage acronyms. And every one of them, I was looking at these, I was like, what in the hell is this? I'm like, what does this mean? Yeah. What does this mean? Well, luckily, Colorado's a 10-hour drive. So by the time we got out there and got back, I had a pretty good idea what all those acronyms were. But I take it.
Yeah, we really try to, we take it for granted. We just forget. I mean, we're in it every day, all day. So we just expect other people. We don't realize like, hey, that's like speaking French to somebody that's never learned a word of French. We just need to lay it out. So that was good. Appreciate that. So one thing to think about though, when you're a resident, you're not paying on those student loans yet. Correct. So a lot of the times where other people run into problems and where other people that don't get physician loans, they have to also include their student debt because they're immediately, as soon as they're done with college, they're having to pay on those loans. Well, physicians don't. So that's another positive of this is they don't actually start charging against that until after either. So your DTI is able to be a lot higher.
Yeah. And let me elaborate on that a little bit. So if you're a resident physician, if you're a resident or a fellow, because I've never seen a fellow make more than, maybe $75,000 to $90,000. And that's probably if you're like neurosurgery on your fourth
year of
fellowship. Yeah, you got to be neuro to even go long enough to get to that level. But even then, most physicians, I think the average, you would probably know this better than me, but most physicians, what I've seen come out of school with anywhere between $250,000 and $550,000 in student loan debt.
Yeah, it's crazy.
When we talk about conventional lending and conventional lending policy, those loans are deferred. They are deferred. Naturally, when you come out of med school and go into your residency, you're not having to pay on those, like Scott mentioned. But conventional lending doesn't accommodate that for different professions. The way that the conventional lending policy is written, you have to calculate as the loan officer for someone that has deferred student loans, as in they're not making a payment currently, you have to calculate a 1% payment. So, folks, if you have $500,000 in student loan debt, I have to use a payment of $5,000. Well, if you're a resident first year, you're making PGY1 typically nowadays make about $56,000 a year, which equates out to just under $5,000 a month, let's say. Well, your debt to income ratio is 110%. You're not getting a conventional loan.
You're not buying anything.
No, you're not buying anything. So really the physician's loan is the only avenue for a resident and fellow, unless you were blessed enough to not take loans for your med school training. And unless you're in that very, very rare category, you don't have an option to buy other than a physician's loan, because the physician's loan, we exclude that. If you have student loan debt that you're not paying on and you're not going to be paying on it for the next 12 months, we pretend like it's not even there. There's no payment that gets calculated into it, no nothing. So that allows those residents and fellows. Oh, it is. I mean, it's life-changing for those folks. Like you mentioned earlier, people that were buying in 17, 18, and 19 in residency, man, that's probably going to be one of the best financial decisions they'll make in their whole life with what the market's
pay off their student loans.
Yeah, I had a guy that did that. He sold his house in Columbia after residency, made $200,000 on it, and paid off almost all of his student loans because he bought at the right time. And instead of paying rent to somebody for 5 years while he was in surgery residency, he paid his mortgage. So it makes a big difference. And that student loan part of it is what makes it possible for the folks still in training. When you get out of training and you start making payments on those student loans, or a lot of times, Scott, we get somebody that's coming in out of training. They've got a contract signed. They're going to finally be making good money, but they've got that student loan debt. Well, now it's not going to be automatically deferred because they're coming out of training, right? So we do have to hit them for a payment. 99% of the industry is hitting them for a 1% payment. Arvest, another part of this policy change that we made back in 20 and 21, we took that down to a 0.5%. So now we calculate their student loan payments as a 0.5% payment instead of a 1% payment, which honestly, in a lot of scenarios, doesn't make much of a difference. But going into this raising rate environment, it's making a big difference for a lot of customers.
I was going to say 0.5%'s a lot when you're talking several $100,000.
For sure. That's $2,500 a month difference if you have 500,000 student loan debt.
Yeah, that's a huge difference in your DTI ratios and how that works. I don't care how much money you make. I mean, that is big. Excuse me. One more thing that I wanted to touch on that I feel like is pretty a question that we get a lot. How does it work when a physician's coming to, all right, so they match, urology just matched, a week or two ago, so they're getting ready to come. All the other specialties, I believe, match, next week, March 1st, typically, the first week of March. Typically. How does it work? Because typically you can't close on a loan too soon. What do you guys do? What's unique about that? What are you guys able to offer a physician so that they can close maybe a little bit earlier than a traditional loan?
Absolutely. That's another great question. So at Arvis Bank, we stretch that time frame. Conventional loans, and I'm going to keep kind of, using conventional as like the baseline to compare.
Great comparison.
So when you're doing a conventional loan, you're moving from one market to another. You're moving from one state to another. I've had many non-physician clients do this. It's called a trailing pay stub transaction, which what that means is that we are not going to have your pay stub for your job you're taking when you close. We have a signed employment contract or an offer letter or something to that, that tells us what you're going to be making, but we don't actually have the pay stub because you haven't started the job yet. Conventional allows us to go 60 days back from your start date. So non-physicians, if you're buying a house in Kansas City, you're moving here from some other market, if you're doing a conventional loan, we can close. If you start your job August 1st, we can count back 60 days, and that's the day that's the soonest that we can close on a home for you. With the physician's loan, we stretch that an additional 60. We go 120 days before you start the job. I've got a physician I talked to this morning. He's starting his job on 8/1. And we were talking about, all the ins and outs of it. And he's like, 4/1. I was like, well, it's not 4 months. It's 120 days. And I calculated it out. I think it was like 4/2 or 4/3. So he can actually buy a house, 4 months, 120 days before he starts his job, which allows him to get his family relocated here, get furniture in the house, get settled in, and then start his job. So,
John, I got a little bit of beef here. How come I'm not working with this client?
Because he was sent to me by another realtor, unfortunately. You should. Maybe I can flip them. Maybe I can flip them.
I mean, no, I don't want you to do that. You got to have all your relationships. No, but I think that is something that's very important because what you got to understand is typically conventional loans. You also have to have pay stubs already at a job or in that same sector for up to 6 months prior to, typically as well. So this is a very unique option that they give you. And physicians live a very interesting life, right? Residents, all they do is really work. I mean, it depends on your specialty, but the reality is it is a stressful time right now because they're matching to a new city most of the time they've never been to. They're packing up everything if they have a family or not, and they're moving to somewhere they've never been. Not always, but a lot of the times people that we interact with. So they've got to find a house, move here within usually a couple of weeks gap is all they get between finishing med school and starting residency. But in the meantime, all before that, they have to find the house, close on the house, get everything scheduled, move here, start residency. I mean, it's back. It is hectic over the next couple of months for them. So giving them that little bit of freedom to start a little earlier instead of rushing to close, within 60 days is huge. That
Like you said, it's just
it releases so much.
It opens that window because, like, I can't tell you how many doctors that I've worked with over the years that, like, they've got 2 opportunities to buy a house and not do it sight unseen. They're going to come in like in April, and then they're going to come back in June. If they can find something in April, great. If not, all the pressure's on for that June trip back, because very rarely is someone coming out of training at KU and signing on at Children's Mercy or vice versa. A lot of times, from my experience, I feel like we're getting into this relocation season, and we're getting doctors that are coming in from some market states away, and it's not a convenience for them to be able to find a house. So being able to open that window of opportunity for them to 4 months instead of just 2 months, that is a huge difference maker for them. And a lot of, I can tell you, it makes a difference because I feel like most of my doctors buy 90 to 120 days out just to make sure that they get something locked down.
One thing that we really push, and a lot of it comes down to who you're working with too, because the reality is I hope most of you are working with realtors that also understand your lifestyles, because it makes a big difference, right? If the real estate agent doesn't understand kind of how this all works, they're not going to push you, number one, like they really need to. And it's not that we're pushing you in a negative way. It's that, hey, we need to put some urgency in this, because really the sooner we can find this house and get it all under contract, the better it's going to be for you, because you're going to run into a lot of things come the summertime when you think, oh, we have time. We really don't have time. We want to get you here as quickly as we possibly can. I want to introduce you to the Kansas City market. I want to drive you around and show you different neighborhoods. And then you're back home on Sunday. You fly in Friday or Thursday, you're back home Sunday. I've got to build that trust as your real estate professional in comfort for you to be able to make a decision without possibly even seeing the house in this market. Like, that is, I would say, John, over half of the houses we work on together are sold without the physicians even getting you to see it, or the medical professionals. Like, they're just trusting me, and I'm doing video walkthroughs, and we're really trying to cater to them in any way. But we also put that urgency in, like, hey, if we could find a house sooner than later, because the real estate market picks up as we get into summer. So now you're competing with more people. So honestly, urology has one of the best programs when it comes to match day and everything else, because they do it 2 weeks before. It's 2 or 3 weeks before anybody else, or whatever. I don't know exactly, but it's they get a big jump start. And it doesn't seem like that much, but that is huge in the grand scheme of all of this, because
big time.
They get a head start ahead of everybody else. They can be approved. They can actually be in Kansas City, usually at the same time everybody else is figuring out where they're even going. They're already in Kansas City or wherever they're going. Sorry, I'm saying Kansas City, but whatever market they're going to, they're there looking at houses, or at least familiarizing themselves. But that's what I tell everybody I talk to is, like, look, we can help you buy, rent, whatever, but you got to get here fast. We got to get you hooked up with Arvis. We got to do these things, and it's going to be boom, boom, boom. And then you're gone. And then you just got to have trust in your lender and your realtor to get it done for you, because
Scott,
it's crazy.
One of the things that I think that you are the best at, and you're great at everything, of course, right? But one of the things that I think that you're really great at is setting those expectations, because you've lived it. You know what that hectic life's like because of your fiance. I mean, you know what their life's like. You know what little time they have to make these massive financial decisions. And so having that firsthand experience really puts you ahead above a lot of your competition, a lot of people that you work side by side with. And other thing I think you're great at is really understanding this product and being able to explain this product potentially to a listing agent or a seller that doesn't know the product. Because I can tell you how many physicians to come to me and work with some agent, great person, but they don't know what a physician loan is. And they're not selling it like a physician loan, because, again, these loans, I mean, they're phenomenal. And we have a very simple checklist to get them qualified. And when they're qualified, as you've seen, they're qualified. So whenever you take the equation out of money down at closing, and don't need to pay closing costs, that asset piece of it, when you take that out of a loan qualification, that's like the biggest one that gets a lot of people. So having a physician product like this, like we have, in a partner like you that knows how to sell this product to the listing agent. No, this is not 100% government loan. This is a doctor loan.
We run into that a lot.
A lot.
And it's crazy to me that people just, I guess, again, we don't know what we don't know, but the reality is like, this is one of the best products probably out there. Like you're talking some of the best borrowers because of the overall amount of money that they will make. And your guys' ratings, I'm like, Arvis Bank is one of the best banks there probably is when it comes to financial structures, sound, So I have to, the first thing I do is call an agent and just explain to them exactly what we're doing, why they're going to see what they see on the contract, because all they see is that we're financing 100%, and they think, oh, VA, oh, this is bad, they need money to borrow. It's like, no, they don't need the money. They have this option. Why wouldn't they take advantage of this? Oh, right. And it's a product that with one of the best banks there probably is in the entire area. Like you're not going to get much more credit than Arvis.
Right. You're not going to get much more strength as far as like competitiveness of that offer. You know, and I think that's what I found over the last couple of years. I started in a lot of instances like just volunteering to the physician. I'll talk to them and say, hey, I'm not saying that your agent doesn't know what they're doing, but please let me talk to your agent. And I tell the agent, please let me talk to the listing agent, because it's imperative that they understand this product. I got to be careful for compliance reasons, kind of what I say, but this is like one of the simplest loans from a qualification standpoint. And we hold it on our books. We're not selling this to UDM. We're not selling this to Wells Fargo.
Exactly.
We're not selling this to some other person. When we underwrite it, we don't have to then send it to someone else to underwrite it. We underwrite it. And like I said, I underwrite them all on the front end on my own. It's just my own personal policy, because again, if I'm going to put my name on it, my stamp of approval, I need to be the one responsible to make sure that this deal is going to close. That's what I owe to my partners like you. But when we issue the letter, the deal's closed. I mean, it's going to close.
Yeah.
Because
exactly.
There's not anything that can come up. Again, student loans, doesn't matter. They're excluded. We see all these different things. And I feel like you said, VA, I didn't want to throw VA out there because our man Ryan being a veteran, I don't want to think anything bad about his VA loan, but they get compared a lot, and they're not even close to the same.
Yeah.
And they could not be any more different, really.
And VA is a great product. It drives me crazy when agents discount it. It's like, this is a great product. Like they just don't understand it. And that's pathetic, because in this industry, you should understand all the different types of loans and what they really mean versus just judging it.
Especially if you're going to give your client a recommendation or advice based on that product. If you don't have the knowledge of it, you're not really in a position to be giving advice on it, in my opinion.
Exactly. It's insane. But no, the one thing the reason I got into working with physicians and where I met John and doing this is because of my fiance, and just seeing what all of them were going through when it came to, they're so good at what they do. And then they just kind of, they don't ignore the outside stuff, but it's like they don't have time to comprehend it, because when they are off or when they have time to do something, that's the last thing they want to do is worry about, financial stuff or real estate or fixing maintenance on my house. So I just kept seeing it over and over again. And I thought, man, there is a real niche here to really understanding this and providing a top tier service for these individuals that really they're the best clients I've ever worked with. If I'm going to be honest, because they really do. And they put a lot of trust in us, which I trust them when I go see my doctor. I trust him to tell me what I need to do. I would hope they trust me to help them and guide them through this whole real estate process. And then we go a step ahead and when we say, hey, not only can we help sell this house, but like any of your vendors you need, anything when you come to town that you need, like, please reach out. We have all these different products, all these different people we can connect you with. Like, we try to make it an all-in-one shop to where you don't don't worry about your real estate when you come to Kansas City. Call me. I got you. We'll link you to John.
I couldn't have said it better, man. You hit the nail on
reality.
the head. That's exactly how they are. I mean, I can't tell you how many, massively successful, specialized surgeons have told me, I'm just a dumb surgeon. I don't get any of this. I don't understand any of this. Or they don't teach finance classes in med school. I can't tell you how many of them I've had tell me that. And it really dawned on me, like, they're being honest. They don't have enough room in their fire for this iron. They've got all the other irons in their fire, and this is one of the ones that they don't have room for. And they're looking for someone that they know, like you and I, has their back. And we're going to do right by them. We're going to give them good recommendations. We're going to put ourselves in their shoes and really let them tap into the knowledge that we have about what we do good. Like, I don't know anything about medicine, nothing. I mean, that was not my strong suit. I know a lot about finance, but I don't know anything about medicine. So it feels really good when they give us that trust, because we are here to help them, and we are here to make sure we put them in the best situation that we possibly can, and really hold their hand, all the way through the process. I tell a lot of doctors this is like my elevator speech to them. I say, hey, you're driving the bus. All right. I'm just riding shotgun, and I'm telling you where each turn takes you. All right. This is your bus, though. Yep. You're driving it. I'm just riding shotgun.
Yeah, no, that's exactly right. And the reality is, like, we're trying to make lifelong clients, lifelong friends. I mean, most of my clients become great friends, but we're not. There are a lot of predatory people out there that do take advantage of, vulnerable people that don't understand these things, and it's pathetic. Like, that is sad, and it works for a lot of people. And doctors are some of the most vulnerable, in my opinion, because they don't have the headspace, and they make a lot of money. And the thing is like, people want a piece of that, so they'll do whatever it takes to get in. And it's like, hang on a second, get out of the way. You got to find a few that you can really trust. I help set a lot of them up now with the right financial advisors, or just recommendations across the board. Like I said, it's not just a one-stop shop. Hey, I'm your realtor, I'm gone. No, I want to truly help you, and so does John. John, on the back end, you're doing a lot of banking for him now. Like, they don't come over to you expecting. We have a client we closed last year, I think it was, or maybe 2 years ago now, but you're doing a whole loan for his pool right now, and he was never expecting to switch over banking to you. You guys offered such an amazing product to go and do this big pool install that he's doing, and he's like, holy cow, this is better than anybody could even come close to offering me. So it wasn't just the loan on his house. Now they're doing banking and all this other stuff with you guys.
That's what I always say. Like, our physician loan's just the olive branch. Like, we just, that's the olive branch, that we offer them. 90% of these other institutions that offer a physician loan, some of them just require a bank account and direct deposit and auto draft out of that account, which basically, with direct deposit and auto draft, they kind of force place them into doing their primary banking there. Some of these physician loan places, they require, like, bank account, $10,000 minimum in the account at all times. If you close your account, we call your note due. Like, Arvis, we don't care.
Holy cow.
We don't care who you bank with. We don't require you to bank with us. You don't have to open an account or anything like that. This is truly the olive branch that we offer, and it's so funny. I remember who you're talking about, those clients. I know exactly who you're talking about. And I remember kind of pitching it to the husband, and I was like, hey, I know it's going to sound like, I'm trying to convince you. I don't care who you bank with. I'm like, I legitimately don't care. And I'm like, and if our banking services sucked, I'd be the first person to tell you. I don't have the ability to blow smoke at you. I'm too honest of a person. I'm like, but you guys have very busy lifestyles. Both of them are extremely successful professionals. And let's be honest, banking is not a convenient thing really for anybody these days. Banking's not like something that's just a convenient part of your life. A lot of times it's like, oh, damn, I got to go to the bank today. Like, oh, I forgot to go to the bank today. And that was the one thing that I talked to the husband about most specifically, which he was my point of contact through the process almost the entire time. I don't know that I ever spoke to her really, but I just told him, I said, this is something that you need. You don't know that you need it, but you need it because it's going to make your life so much easier. And I lined him up with one of our best private banker. And she worked on the retail side as a branch manager for like 10 years. So she knows every product that we offer front and back. And I lined them up with her, and it's been life-changing for them. And not only because—
Yeah, what's funny is he kept hitting me up. He said, man, your boy John keeps hitting me up. And I just thought, oh, Johnny, what are you doing? But then he comes back to me a few weeks later. He's like, hey, they actually offered us the best product we could get. And we talked to all these different people, and this is the best one. It's like, I mean, they love physicians. They love medical professionals over there.
We do.
And John is going to come after it. If you tell him you're going to do something, like, I would at least give Arvis a shot, to be honest, because they offer, I haven't seen better stuff for physicians, to be honest.
There's nothing better out there, and I know that because of how many doctors have told me, like, hey, you undersold this. Like, hey, next time you should try overselling this a little bit more because you told us it was great, but it's life changing. It's unbelievable, and it's just from like think about how many surgeons, right? They get settled into a market, and the first thing, once they get rooted in their practice, they get offered to buy into a surgery center, right? Well, there's not a lot of places that'll do those surgery center loans. One of them that will is Bank of America, and we know what it's like dealing with them. You know, a lot of times it's not very easy.
Gotta love them.
Gotta love them, but hey, they're America's bank, but they're not the easiest to deal with in some of those situations. You know, and I've had multiple surgeons that our relationship was established with the physician loan, but it really gained traction when they wanted to buy into a surgery center to really create that passive generational income that could last years and years. And not many other places would, you know, turn their nose up at them. And then they got to Arvis and we're like, oh yeah, we do these all the time. No problem. Like, not an issue at all. So it's, man, from pool loans to surgery center buying loans to, we do personal lines of credit. So if you're a physician, you make $500,000 a year. Let's say your spouse makes $100,000. That's $600,000 household income. We will do a non-secured personal line of credit for you for 25% of your gross annual income. So you can get a $150,000 line of credit with us, non-secured, not collateralized.
Ooh, I need to come to you guys.
It's a great. I'm telling you, and that's just the surface. Loan. I know you do. I know you do. But I mean, it's just an example of everything that we do. We have like a special endorsement for private banking, and if you're not a physician, you have to have a $500,000 relationship with us to be in private banking. If you're a physician, you have to make the minimum deposit of $50 into your checking account, and you're in private banking. So people are always like, what's the catch? And I'm like, I know it sounds like there should be a catch, but there's really not. We just love doctors. We love them, and we want to fully bank them.
Well, I mean, they're great clients. Once you build that trust with them, they trust you. I mean, you service them well, and
they get preyed on a lot. So that's what I think it takes is you've got to really build the trust with them. You've got to show them that you really do truly have their best interests in mind.
No, I would absolutely agree with that. And we do. And the reality is, you know, we got to take care of them because they are, in my opinion, somewhat mistreated in a lot of ways, especially in our professions. Like, people do not respect them like they should. Everybody's like, oh, they make so much money. It's like, yeah, you don't realize the amount of training that a lot of these folks have, the amount of hours that they actually work. When you start breaking it down, it's like they make okay money per hour.
I mean, the amount of weight that they carry being responsible for people's lives. I mean, you know,
and dealing with people's BS constantly. Like, how mad are we when we're in hospitals, or how, like, people aren't in the right mindsets a lot of the time, so they're dealing with all these crazy things. So anyway, we can go on a tangent there, but Arvis is trying to really take care of these medical professionals, and I love it.
They get treated. You know, we're trying to show them that there is a better option out there, and that they do deserve to have that, you know, that one place that they know is going to have their best interests in mind and be there to fully serve their every financial need, whatever it is. Yeah. We're there to serve you.
I love it. Well, John, no, I appreciate it. It's been a great time talking with you. We're running a little bit long here. Ryan, do you have any questions, or John, do you have anything last minute that you'd like to kind of say, a little pitch?
I just want to thank you guys for including me on this. You know, this has been really cool. And, you know, it's an honor to be sitting here with the two of you guys, you know, chatting about this. And, you know, if anybody ever has any questions, obviously I'm happy to answer them. I'm an open book.
Where can they find you? Give us your information there. How do they get a hold of you? How do they find you?
Yeah, I mean, the best way is just to call me on my personal cell phone number. I'm available 24/7. And I don't know if you,
except for when he's holding his baby and they're screaming, crying.
That's right. And sometimes if it's a hot enough fire, I'll still answer, but there might be some background noise. But really, I don't know if you guys want to put my information up, or if you want me to.
No, we absolutely will. We attach it to the podcast.
Cool. Yeah. I mean, they can reach me on my cell or via email anytime. And Scott can attest to this. I'm available 24/7. One of the big parts of my business is that I work when my clients need me. I'm not the Monday through Friday 9 to 5, because like me, most of my clients have jobs and they work those hours Monday through Friday 9 to 5. So it's about being available when your clients need you. And that's a big principle that I've built my business around, when I started 8 years ago, and I lived true to that. I'm available when you need me, and that's determined by you. Call me when you need me.
Yeah. Yeah, John, we appreciate it. I feel like you gave tons of value, especially to the physicians that are going to be put in the position to buy soon, and not knowing that, the product exists. We're limited to certain states, but there's still a lot of physicians out there that could benefit from this program and save money and a lot of headache using, people that have dealt with this before. And I mean, it's kind of your bread and butter, right?
Absolutely. Yep.
So yeah, we appreciate you having on. We'll link all your info in the show notes, or if it's YouTube, in the description. Is there anything else you have before we sign off?
No, thanks a lot, guys. I appreciate it.
All right, great.
Thanks, John.
Thanks for listening to Explore Podcast. Be sure to follow us on all social media, and we'll catch you next time.